Consumer price inflation for August came in at 6.69% year-on-year, which is a tiny bit lower than July's 6.73%. Let's do a three-point analysis to understand why, given the current state of the economy when demand is still sluggish, growth is dismal, inflation is still high. 1. India's CPI inflation versus other countries. Well, most countries have rates of consumer inflation lower than India's, and that is despite their growth contraction being much less. For example, consumer price inflation in August was 1.3% in Indonesia, minus 0.5% in Thailand, 2.4% in China and the Philippines, 3.18% in Vietnam, and 2.4% in Brazil. And in the developed world, inflation is either very low or negative. 2. The toxic mix of high inflation and low growth. Well, food prices are the usual culprit, up 9.05% year-on-year, which is slightly lower than July for sure. Vegetable prices were up 11.4% and pulses were up 14.4%. The explanation is that the local lockdowns and floods have disrupted supply, leading to the spike in prices. With the easing of the lockdown, supply disruptions should abate and food price inflation is also expected to moderate as a bumper crop hits the markets. But it isn't just the food prices that is pushing up inflation. Taxes have pushed up prices of liquor by an extortionate 25.5% and beer by 26.6% on a year-on-year basis. Even the poor man's booze hasn't been spared, with toddy prices rising by 19.7%. Now, within the personal effects category, gold prices were up 44.6%, silver was up 52.7%, and other ornaments about 24-25%. But this is not due to the high demand, but supply impediments or higher taxes or higher global prices. 3. Will inflation ease going forward? Well, as the disruptions from the world's most stringent lockdowns fade away, inflation should fall back. But note that inflation on account of gold and silver and higher excise duties and other taxes will remain high when compared to a year ago. Also, the recent spate of tariff and non-tariff barriers could also raise prices, although much depends on the strength of the rupee as well. Now, CPI inflation remains above RBI's comfort limit of 6%, so a rate cut to push growth seems ruled out at the next meeting of the Monetary Policy Committee, scheduled from September 29 to October 1st. Also, lowering of interest rates will further also do little to boost the credit. As of 14th of August, we've seen little growth in the non-food credits, about 5.5%. And that means that credit growth, after stripping out effects of inflation, has been contracting in the real terms. Now, banks are not lending to those who really need the money, and it remains to be seen whether the restructuring of loans will make a difference.